You're close to saving thousands of dollars by refinancing your loan. You've run the numbers, the new payment looks tempting, and you're ready to make it happen. But there's one question holding you back. Is this going to completely wreck your credit score? Let me put your mind at ease. The short answer is no. And over the next few minutes, I'll show you why the temporary dip in your credit score is just a small speed bump on the road to big savings, and how to keep that dip as small as possible. So, what exactly is refinancing? It's simply the process of replacing an old loan with a new one that offers you better terms, like a lower interest rate. You're taking out a new loan to pay off the old one. This can be for a mortgage, a car loan, or even a personal loan. The goal is always the same: pay less to the bank and keep more for yourself. But this creates a tough choice for a lot of people. You're caught between the promise of saving real money on one hand and the fear of damaging your credit score on the other. That's a valid concern. You've worked hard to build that score. So, let's get into what actually happens to your credit when you refinance. The moment you officially apply to refinance, any lender you approach will need to check your credit report. This is called a hard inquiry, and it's the first and most immediate effect you'll see on your score. But here's the reality. For most people, a single hard inquiry will only knock your score down by a few points, typically less than 5. It's a minor temporary dip. While the inquiry itself stays on your credit report for 2 years, it usually only impacts your score for the first year, and its effect lessens over time. So, while it does cause a small drop, it's not the credit disaster you might be imagining. Now you're probably thinking, okay, but what if I apply with 3 or 4 lenders to get the best rate? Won't that mean 3 or 4 hard inquiries? This is where you have a secret weapon. Credit scoring models are designed to be smart. They know you're going to shop around for the best deal on a major loan. Because of this, all mortgage or auto loan inquiries you make within a specific period are treated as a single inquiry for scoring purposes. This shopping window is usually between 14 and 45 days, depending on the credit score model. To play it safe, it's a smart move to get all of your applications submitted within a 2-week window. This lets you hunt for the absolute best rate without worrying about multiple inquiries dragging down your score. The other way refinancing can affect your score is by changing the average age of your credit accounts. When you refinance, you are closing an old, established loan and opening a brand new one. The length of your credit history makes up about 15% of your FICO score, so closing an older account can temporarily lower your score by reducing that average. If the loan you're refinancing is one of your oldest accounts, the effect might be a bit more noticeable. But just like the hard inquiry, this is usually a temporary adjustment. Your old loan's positive payment history can stay on your report for up to 10 years if it was closed in good standing, so you don't lose the benefit of all those on-time payments. Let's put all the pieces together. You might see a small temporary drop from the hard inquiry and another small dip from lowering your average credit age. But how does that stack up against the benefits? The truth is, the long-term financial gain from refinancing almost always outweighs the minor, short-lived hit to your credit score. That 5-point dip, which will likely recover in a few months, could be your ticket to saving hundreds of dollars every single month. Over the life of the loan, that can add up to tens of thousands of dollars. It's a strategic financial decision, and the temporary credit impact is just part of making it happen. The good news doesn't stop there. You can take steps to help your score bounce back fast by following a couple of simple rules. First, and this is the most important one, start making on-time payments on your new loan from day one. This immediately begins building a fresh, positive payment history. Second, try to avoid applying for any other new credit, like credit cards or other loans, right around the time you refinance. This helps prevent extra hard inquiries and keeps your financial picture looking stable. By simply managing your new loan responsibly, your score will typically rebound within just a few months. So, how hard does refinancing really hit your credit score? The answer is not very hard at all. You can expect a minor, temporary dip that is a small price to pay for what can be massive long-term savings. The key is to be strategic. Shop for your rates in a tight window and be diligent about paying your new loan on time, every time. Don't let the fear of a small credit score dip stop you from making a financial move that could save you a fortune down the road. If this video helped you, make sure you subscribe for more straightforward financial advice. And let me know in the comments. Have you ever put off refinancing because you were worried about your credit? I'd be interested to hear your story.